This Week in Startups is brought to you by Squarespace. Turn your idea into a new website. Go to squarespace.com for a free trial. And when you're ready to launch, use offer code TWIST to save 10% off your first purchase of a website or domain. And Fiverr. Find the perfect freelance services for your business. Go to fiverr.com and use code TWIST to receive 10% off your first order.
All right, everybody, welcome to This Week in Startups. It's our news roundtable. You guys love to talk about the news. You like to get my unvarnished opinion on the news. I recently had somebody call me and admonish me because I was talking about the news on Twitter, and I said, have you not been paying attention? And they said, I don't understand. Why do you share your opinion? And I thought about that for a second, and I was like, well, that's what I've always done. Like, but how does this serve you? And I was like, never really thought about that. But thank you for the candid feedback. We are now in well into month 2 of quarantine, shelter in place. If you're watching this as a historical document, it is May 19th, 2020, and we are deep in the coronavirus, COVID-19 pandemic, and it's an absolute unmitigated disaster. We won't get into that. Today, we're going to talk about the news and try to give you a break from talking about politics and the pandemic. Of course, it will come up, I'm sure. With me today, 2 really just great podcasters who I discovered who have a great podcast called Acquired.fm. And I was recently on it. And they are the co-founders of Pioneer Square Labs, which is like a startup studio, VC fund in Seattle. And I'll have them explain what startup studio means in this context, or if they're mainly just investing. But I was recently on their podcast, and we did 2 hours, and we just had great chemistry. So I said, hey, let's see if we can recreate this and have you on the roundtable. Ben Gilbert is with us. He is Gilbert on Twitter. Ben, how are you doing?
Thanks for having me, Jason. Doing well.
And Ben, you are the co-founder and co-host of Acquired FM. How long have you been, let's start with you giving the background on Acquired FM. How long have you been doing the podcast? What has it done for your business? What's the goal of the podcast, the mission?
Yeah, we're coming up on 5 years. It's been 5 years a side project through 2 different companies that I've been at, 2 different companies that David's been at. The goal has been
5 wonderful years.
Yeah.
Spoken like a true married couple.
Yeah, that's right.
5.
Well, my wife, kind of gets jealous sometimes. That she says that I text with Ben more than I text with her, and she would be right.
And David Rosenthal is your partner, of course, Ben, and he's got the radio voice. He's got us both beat, Ben, with that soothing
It's true.
David Rosenthal public radio voice. David, why don't you
I'm the
explain
voice guy. Ben's the intellect.
Yes, exactly. You said it, not me. Tell me, what is Pioneer Square Labs? Are you a startup studio like Science and BetaWorks, or are you more of a VC, or a little bit of both?
Yeah, a little bit of both is the right way to describe it. We started purely as a startup studio, which means we co-found companies with entrepreneurs, big dev, design, data science team, come up with ideas. And sometimes, there are ideas. Sometimes other people bring us ideas. But the thing that's common among all 20 VC-backed companies we've spun out is that we sort of co-create them, co-found them with entrepreneurs. And then we've got an early stage venture fund that we use to invest in all the Pacific Northwest companies that we don't start.
David, when you start a company with Ben and some founders, how does that economics work, broadly speaking? The criticism I've heard of, the Science or the BetaWorks is that they take a very large portion of the equity, and then they give a small portion to the founders, and then they try to raise money. And so they get basically higher gun founders. How would that economically work out if I were to join you and work on an idea you had? How would that work?
Well, that's a better question for Ben, although Ben and I have started multiple companies together. I am not part of Pioneer Square Labs. I'm just an investor.
Got it.
So
I didn't realize that, actually. Okay, so David, you're just drafting off Ben. Got it. Ben,
yeah, exactly.
You explain.
That's been my plan all along, and it's worked out beautifully.
So Ben, how does that work cap table math-wise, just for people listening who might want to become CEO of one of your companies or maybe want to come work with you?
Yeah, totally. Well, certainly every situation is different, but the commonality is that we look like a co-founder on the cap table. So obviously a meaningful amount of equity, all in common, so that we sort of participate and get diluted down the same way the founder does over time. And the bet that you're making by starting a company with us is that that sort of massive amount of acceleration early, building out a great team, validating a product, not feeling around in the dark for a long time is worth sort of that co-founder amount of equity.
Got it. And then you might also put in money. Of the 20 companies who've done this, which one would objectively an outsider say, hey, that's the most successful, raise the most money, largest number of employees, largest amount of revenue, any of those vectors?
Yeah, a few that people might have heard of. One is Jet Closing in the title and escrow business. Just did a $20 million Series A from T. Rowe Price.
Wow.
Another might be Boundless, which did a Series A from Foundry Group, helping people immigrate with confidence. So there's a few out there that are maybe well known by consumers.
How do downstream investors think about you? Do they look at this co-founding thing as an asset on the cap table to have you there? Or do they look at it and go, we got to buy some of those shares out? Because that's what I've heard is kind of what happens with some of these startup studio companies is in order to keep their funds evergreen or keep the money coming in, they're structured sort of as evergreen funds. So if you were to take the company to T. Rowe, you might sell them 10% of your shares, get more money to start the next company and to balance out the cap table. Is that what actually happens in your case?
I could see that happening later. Hasn't been a big driver for us to date. The way that the downstream investors that we've sort of chosen to work with look at it as they know us, they know that we're sort of valuable as co-founders of the company. The reason why we raised from 14 venture firms when we put together the initial capitalization for the studio was to basically say, hey, who select in if you're interested in sort of funding companies that we start. And obviously now there's dozens of companies that have been involved in raising from external VCs that had nothing to do with capitalizing the studio itself. But initially we did start with a core group of VCs just for that reason of knowing that we had a group that was sort of bought in on the model.
All right, so let's get into the news. Clubhouse is a audio phone. I would describe it as
social audio.
Social audio. That's a great way to describe it. Yeah, you basically open up the app. You see a bunch of talking heads. You see folders. Basically, in the folders are conversations. In those conversations, you will have, maybe 2 to 10 people talking simultaneously, like on a conference call. So it's a little bit of bedlam, but people tend to figure that out pretty quickly and mute themselves or direct the conversation to the next person, like with a handoff, like I would say, like I'm doing here in the podcast. Hey, Ben, what do you think of this kind of thing? And then below it is an audience, and you can upgrade people from the audience, like in Turntable FM or some of these other services where they get to become speakers. And the founders of that company did an amazing job having venture capitalists and founders use the product. It's not available yet. It's not yet in the App Store. I got an invite to it, started using it, was like, hey, this could be an interesting investment, reached out to the founders. And then lo and behold, news broke, I think on May 15th, so a couple of days ago, that, I think it might have even been Friday, Andreessen Horowitz had invested $10 million at around $100 million valuation in a Series A for a company that likely, when I've been in it, has 200 people maximum, but typically more like 50 people using it. And the reason I'm kind of laughing is this is just an extraordinarily ridiculous valuation. Obviously, happy for the founders with that. And Ben Horowitz came on the app. I interviewed him actually on the app and asked him some questions about it. And Benchmark had an offer around 75 to 80 million for this. And the reason stated in a story, I think in Fortune or Forbes, for why Andreessen Horowitz got the deal was that Mark Andreessen called Kevin Hart, who is basically in all these internet circles, seems to have his hands in every circle, in the poker circles as well, to come on the app and make jokes. And the founders were blown away by that. And then sold, and this was the controversial part, $2 million in secondary shares, $1 million for each founder to Andreessen Horowitz. So, Ben, what are your thoughts on this, clearly an outlier in funding? And have you been on Clubhouse?
I have. First, I just want to clarify the Kevin Hart thing. In the Forbes piece, I think that was one of the sort of sweeteners that they pointed out may have won the deal. Just in conversations with the founders in the app, it doesn't strike me that they're the type of people that, oh my God, Kevin Hart gave us a phone call, therefore we're going with this VC firm. I have to imagine there was a lot more.
So it definitely wasn't like, get us Kevin Hart to come on for 5 minutes, we'll give you the deal. But I think they wanted to see who could hustle, and the founders have said. I've been in the sort of conversations where Paul says, I really think stand-up comedians will do well in here, and they could have like a paid version where you could kind of do a stand-up set or test new material. So he seems to be obsessed with that concept.
Yeah. Well, I think there's a few very interesting trends going on here. I mean, on the valuation front and on the $10 million invested in not a pre-revenue, but a pre-launch, pre-App Store product.
Pre-approval.
Well, hey, Superhuman is still a pre-App Store product. So.
There you go. That's a good point. What we're seeing here in the funding environment, I think, is this bifurcation where the prices haven't come down for the hottest companies. So the deals that were definitely going to get done are still definitely going to get done, and kind of at the same valuations. It's more those ones that were they going to be able to raise a round, or were they going to fall up? Those are the ones that are having sort of the problem raising the rounds. And so it's no surprise that the very hottest company in consumer social raises $10 million at a $100 million valuation. If you had asked me 2 weeks ago, what's their round going to look like, I probably would have thought it was something like that. I'm not sure I would have realized that the $2 million secondary would be in there as well.
Explain to people what the $2 million secondary is and why that is so notable.
Yeah, David, you've been a venture investor longer than I have, so you may be able to better articulate the mechanics.
Well, it's super controversial because it just gets back to, like, the big question is psychology and motivation. Like, it's pretty simple, on the surface, which is like the founders, had presumably somewhere around 100% of the equity of the company before. They sold, if it's a $100 million valuation, they sold an extra 2%, 1% each of them at $1 million. They still own a bunch of the equity. Why shouldn't they be motivated? But it's just not something that I can't think of a case where this has happened early. Maybe you guys can. And the company ended up working out in the long run. Jason, you've obviously seen.
Well, Secret was the big one that had a very similar pattern, so that gave people a lot of pattern recognition. Secret was an app that allowed you to basically slander anyone anonymously, put a statement like a tweet out, and it would share it with everybody in your phone book, but you would know that they were in your orbit, but not, and so people were just started posting like all these salacious things about people. Anyway, the founders in that case, I think, sold $3 million each, and these dipshits bought Ferraris, drove them to work.
That's right.
And you think
and obviously, presumably that's not going to happen here, but I think if Nassim Taleb were here, he would be all about skin in the game here, and I think that's kind of what it comes down to.
It does, and usually if somebody is selling in the Series B, when the company's at, $100 million or $200 million valuation, has $10 million in investment, what you're saying is, I'm going to reward that founder with $1 million or $2 million buying their shares. They have to give up the shares, so they're selling something. But it'll keep them in the game longer because now they can take the idiot insurance, put down a down payment on an apartment, or buy a dope house in any other city but San Francisco and New York, and maybe it takes the edge off. But, we don't know everybody's individual circumstances here. As somebody pointed out, one of the founders has a very sick child. And so, there could be other dynamics at work, but it does signal, I think, to other founders. And I saw some founders bring up, hey, I am a underrepresented founder. And these, white founders get this craziness. I'm not sure if that's actually valid here, but it does. In fact, I don't know that that's valid. I can understand people having that feeling, but the other thing that was interesting is it does trigger in other founders. I have $1 million in revenue, and I'm having a hard time raising at a $10 million or $15 million valuation. This is not fair. And what people need to understand is what these founders did better than anybody is they got VC, as I call it, VC product fit. And when you get VC product fit, where VCs become addicted to a product, well, then it sets something off inside of them, a spark where they
Psychology, yeah.
It's a psychology thing, and Uber had this as well, where who took Lincoln Town Cars? VCs. And VCs were like, this is better than my assistant calling and getting me a $150 car because it's only $90 and I could watch it come and I don't have to talk to anybody. So I think that's what they had is VC product fit. Lux, the valet for Teslas in San Francisco, also had this. You can pull up
Infinite
to any
VC product market fit.
Infinite
I loved
VC
it.
product fit. And when you have that, VCs will do irrational, and this is irrational in terms of a bet.
Let me
size.
take the other side of this, Jason.
Go ahead. Yeah, please.
So you're calling it irrational. So no enterprise company in this sort of era of technology in the last 15, 18 years has become as big and as successful as consumer companies. Consumer internet companies have, zero distribution costs, zero marginal costs. They don't have to pay for the content if they're Facebook or Instagram. These companies have all the characteristics of...
And if they have a successful viral loop for a long time, they don't have to do any paid customer acquisition either.
Totally. And the network effects are unbelievable in these businesses. And so we haven't seen, there's only been a handful. There's been Facebook, there's been Twitter, which
Instagram.
Sort of plateaued a little bit. Instagram, Snap, TikTok.
MySpace, Friendster. Yeah, I mean, there's been...
Twitter is totally having a moment, by the way.
That's true. But to the extent that you can buy, win the lottery ticket to be in the next one of those, like the upside potential is so high, $200 billion, $300 billion, $400 billion of potential future market cap, that to be a material early investor for the low price of $100 million valuation, like I get it. If something's already showing the signs that it can de-risk some of that, then I don't know.
All right. After this commercial break, I'm going to explain why Ben's wrong on This Week in Startups. Stick with us. Hey, do you have a great idea? Do you want to turn it into a beautiful website? This way, you can reach out to your customers and partners and basically change the world. Well, I just was thinking the other day, wow, we're doing so much remote now, and there's all these demo days that can't occur in person. What if we had a remote demo day? And I checked to see if the domain was available, and remotedemoday.com was available. And then I said, hey, let's put up a Squarespace site. And my team rallied in a couple of hours. We wrote all the copy, we got a video made, and we had a beautiful website up and running at remotedemoday.com. This is what you can do with Squarespace. You can basically come up with an idea and start building your website, whether you want to blog or publish content. Maybe you want to sell a product, or you have a service. Maybe you want to promote a physical or online business, or maybe you want to announce an event or a special project like I did with Remote Demo Day. Well, Squarespace is the answer because you build it once and it's beautiful and it's customizable and it's so powerful with this e-commerce functionality built in and analytics built in, and you can choose between over 200 extensions. You'll get great analytics, search engine optimization, free and secure hosting, and 24/7 award-winning customer support, and it's all optimized for mobile. That's what you get when you use Squarespace. They do have that 24/7 award-winning customer support waiting for you. Go to squarespace.com for a free trial, and when you're ready to launch, use the offer code TWIST, and you will get 10% off your first purchase of a website or domain. Thanks again to Squarespace for supporting the podcast for years and for making amazing software, an amazing platform, and having just that incredible wherewithal to just release feature after feature. Great job over there at Squarespace. Okay, let's get back to this amazing episode. All right, welcome back to This Week in Startups. Ben Gilbert is with us. He is the co-founder of Pioneer Square Labs, which is a startup studio VC firm in Seattle, and he's the co-host of Acquired FM with David Rosenthal, who is the co-host of Acquired FM. Do you have a day job, David, or do you just do voiceover work?
Mostly I just do voiceover. No, I'm an investor. I've been a VC for over a decade.
Where are you
now.
a VC?
So I was at Madrona for up in Seattle for which is where Ben and I met for many years. I worked at Meritech, and then a couple of years ago I co-founded a seed stage fund called Wave Capital. But now I invest on my own.
Great. Okay, solo investor. I like it. So Ben, your position, I think, is understandable, right? If this is in fact an outlier, and do we have enough evidence here that this has the viral loops that would result in a $10 billion outcome? A $10 billion outcome, if you invested at 100, is 100x, 100 times 10 million. If there was no dilution or you kept up with your pro rata, could be a yum investment for a VC firm. In the case of an Andreessen Horowitz, it would return probably that entire fund. I think they do like $750 million to $1 billion funds. I'm not sure which one this came out of. But if it was a $750 million to $1 billion fund, this one investment could get the fund to the hurdle, right? To the actual break-even point. So it's not illogical. But the number of people who've made it to a $10 billion market cap in social is 4 or 5 companies right now, right? LinkedIn, Facebook, Twitter, Instagram didn't make it. Snapchat did. I think that might be it. So if you didn't have other deal flow, this deal would make sense. However, Andreessen Horowitz has exceptional deal flow. Some might argue, I would argue they're like somewhere between the 6th and 10th best venture capital firm. And maybe in terms of profile, top 5. But just in terms of track record, they're, probably like second tier. And that's just math and statistics. Maybe they'll become first tier later.
They're not the Jason Calacanis empire.
No, yeah. I mean, listen, I've gotten lucky. If you take out the top 6 investments, it's a different story.
Well, hey, that's any venture firm.
I know, that was kind of the joke. Thanks for getting it out. But anyway, my IRR is easier to have higher because I do smaller dollar amounts. Harder when you have the larger ones, obviously. But in their case, if they could invest in 5 companies, $2 million each, at a $20 million valuation, who have more traction, they would be investing further down the line in 5 companies. That's why I think this investment does not make sense and was an emotional and a competition that got out of control, because there's a lot of bad blood between the Benchmark team and the Andreessen team, and this founder did a better job of manipulating and creating a marketplace than any founder I've seen in a long time. What's that?
He created Flashpoint.
What does it mean, Flashpoint? Just, is there a...
Well, given his story, this particular company, the nature of the company, his background being a benchmark EIR, the nature of that bad blood.
Oh, Paul was an EIR?
Perfectly. Yeah, he was an EIR at Benchmark before he started Highlight, which was his previous company.
Oh. And he gave the deal to Andreessen Horowitz? Wow. What do you think about that, David? That's kind of dirty, isn't it?
Well, this is to your point about this psychological competition that happened. I want to come back to real quick to psychology and the secondary.
Oh, but did Paul also sell a company to A16 or had a previous company?
Pinterest acquired Highlight. I think that was the...
okay. Maybe connection. Pinterest was an AC company or something. So anyway, he's probably... But anyway, what was your point about the secondary?
Oh, my point was, it all gets back to psychology. Like, this is, to your point, Jason, this is... there is something interesting and potentially special here about Clubhouse, but this, like, the national anthem hasn't even played yet. Like, we're not even in the first inning.
Right.
Like, there's a long, like on our show on Acquired, we tell the histories of, great companies that have made it to an exit or near an exit. There's so many ups and downs. Like, it is a freaking roller coaster, as you know. And so, like, getting this huge valuation, getting all this capital, getting this secondary before the national anthem is played, it just it does super weird things to your psychology as a company and as founders.
Oh, to them internally. I want to unpack that in a minute, but let me ask you this. You heard Ben take the side of, hey, this is a good deal. I don't want to speak for you, Ben, but Ben, you think it's a good deal and you would have done it. Suffice it to say, if you had the opportunity.
Yep.
Okay. And I think I would rather go with 5 bets. Now, that doesn't mean if the founder calls me now and says, hey, we got a slice for you, I'm not taking it. So let me be clear. Because
there we go. There's the real answer.
Because now there's so much motivation here. Slipping in $100K just to be on the cap table and take a flyer could be worth it for me because it's a small amount of money.
Wait. Unpack that, though. What do you mean? Wait.
Also, that is the exact same psychology that a $750 million venture fund should be taking on something that has this kind of potential outlier returns.
Yeah. For me, what I would look at here is now that Andreessen... I would never, if they said to me, we're doing an angel round at 100 million and we want you to be one of 10 angels, I would say no.
Right. You want to momentum trade it.
I would momentum trade it on Andreessen Horowitz is now all in, and literally Ben Horowitz, his wife, and their like entire network of celebrities
was on it last night.
Yeah. So now it's like, this is going to become for Ben Horowitz and Andreessen, since they've been mocked by the crazy valuation, it's going to be a point for them to bring this over the finish line or really work hard to do that. So there's that like leveling.
It's going to be like when the sports writers were telling Jordan, or were saying that the Bulls were going to be out in 4 and 5 and 6, and he does that. I took care of you.
Yes.
taking care of you.
It's basically like now they've given them the fire in their belly. So now Andreessen Horowitz is going to pour money into this and get they're going to pull out all the stops, which is great. That's the job of venture capitalists. I love it. But let me make sure I got this straight here. David, you would do what I said. Wait till they're in the second inning, third inning, and make 5 bets, or make 10 first inning bets, or 5 third inning bets, right? If you had the same amount of capital.
I would view it a little differently. I would say for the stage at which this company is, at that valuation and with these dynamics, I would have dropped out of the bidding. Like,
for sure. Makes
long
no sense,
before
right?
it reached this point.
Why? Why would you have dropped out?
Because of this, because like there's just so much still unknown. Like we don't know the retention of these users. We don't know the actual like nature of the network effect and how strong it is, and like how
we don't know if this works outside of COVID.
Right. Does this work outside of COVID?
That's another one. Yeah.
Like,
I mean, we can always make a long list of reasons why things don't work. So that,
of course. No. Like, I'm not saying this to throw shade. Like, this is awesome. Like, these experiments should be run. These things should be happening. This app should be built. These founders should raise this money. But like, there's so much unknown that is unknowable right now.
Correct.
Now, 2 to 3 years, they've been operating. They've started to figure this out. They know what the user lifetime is. They know there's more of a view on the intensity of a network effect. Like, right now, again, you guys can say more than me. I've spent no time in the app. You care about who's speaking. Is there any reason to care about who else is in there who's not speaking?
All right, this is good. I think we got through the why the investment is notable.
Now we're into the intrinsic.
Yeah, let's go to the intrinsic value. But Ben, I want to ask you one question about the secondary. What's the most charitable view of the secondary? What's the most cynical view of the secondary? And then where do you land? So what would be, when you're talking to people in the background, and you're a very connected and candid guy, that's why I like having you on the pod and I like being on your pod, what would be the least charitable and the most positive, the most cynical and the most charitable version of giving $2 million to founders in a company that has 2,000 users, let's say?
Yeah, so the most cynical is just saying, look, it's not a bribe because it is a transaction, providing shares in exchange for cash, but it is to say, look, those other guys aren't going to give you cash right now. I'm going to give you cash right now. So do the deal with me.
So basically a bribe. A pot sweetener that a cynical person might say, you're basically paying off the founders to get the deal, which is what people said about the secret deal.
And again, it's a transaction. The shares are worth that because that the fund is purchasing those shares for those price. But yeah, the charitable one, and this is pretty much where I come down, is I don't blame anyone for doing this. If you look at each actor in the equation here, you look at the venture fund of why they would do this. It's to win the deal.
Right.
And then you say, well, that's only bad if it's bad for other people. Could it be bad for the LPs or bad for the founders? For the founders, I think it's perfectly reasonable. I mean, this really if
I'm a founder of a company that hasn't launched yet, and you can buy 1% of my shares for $1 million, let's go.
But
I mean, every founder
there's
takes
still
that
so
deal.
much risk ahead. Yeah,
obviously it's great for them, but I think it's reasonable for the VCs to give them that, because I think the situation that you described before, it's an opportunity to put a down payment on a house, or pay some medical bills, or do something that basically puts you at ease, so that, oh my gosh, you can go and focus all of your attention now on running and scaling this company, where you're not. Your incentives are with the VCs to go make it as big as it possibly can be, rather than being, try and do a small exit or something so that you get your cash, even though the VCs didn't get their multiple. And so I like the incentive alignment there. So that's why it makes sense for the VCs, for the founders. And then I kind of talked about the VCs again. Well, I think it actually makes sense for LPs.
Yeah, so the people who give the venture capital firm their money to invest, like an endowment. So now an endowment like Harvard, let's say, or a retirement fund like Halpers. Let's take a retirement fund. A retirement fund just paid 20% to invest $10 million. They paid $2 million to invest $10 million in this company.
Yep. So let's suppose that this company can go and be a $500 billion company at some point. Then what you're doing there is paying for access to an investment vehicle that no one else has access to. Lots of people do that. It's very common in the finance industry, and it takes many forms. But this idea
what would it be on a percentage typically? And what's an example of that? Access to something that's not available in the finder's fee, as it were.
Like management fees.
Yeah.
Like when you pay a hedge fund 2 and 20, 2% management fee and 20% carried interest, or 3 and 30 in a lot of like great venture firms cases or great hedge funds cases, then yeah, it's
so they're paying that already. So let's assume they're paying the 3 and 30 to an Andreessen Horowitz. Now they're paying another 20%, which would be in the fee bucket essentially. So they're paying 23% fees and 30% carry.
So you could effectively look at it as a higher fee. The other thing to note is like the venture fund does get to hold those shares. So
there's a possibility
it's not primary capital into the company that's going to help them grow, but now Andreessen Horowitz does get to own another 2% of this company, which their LPs hold. So,
Okay. So David, where do you fall on the cynical or charitable, on the cynical to charitable spectrum? Where do you fall?
I fall pretty far on the cynical side. Now, to be clear,
unpack it.
I don't blame the founders at all. Like you said, like this is a no-brainer proposition to them.
Right. We all agree.
Yeah,
founders get the best deal they can.
To me, I fall much more on the cynical side for two reasons. One, like I was saying earlier, like I think a lot of people have justified this kind of stuff very rarely as early as this, but still, like this has been creeping earlier in companies over the last 10 years that this is happening with it aligns incentives. Like it takes the pressure off of founders, allows them to go for the big win. I actually like this sounds harsh to say, but I am a big believer that like when your back is against the wall and you have to make something work, like you have no secondary options, you have no exit plan, you have no 401k, that is often when, you are forced to make things work. And especially this early in a company where, as you say, Jason, you have VC market fit, very unclear if you have product market fit, way more even unclear if you have, an advertising model, a business model, let alone defensibility in that industry. There's a long road to go.
See, this is an interesting point, I think, this is why people were against secondary period. And it was like, well, if the companies are going to if you want the companies to go for a 10-year IPO, IPO in year 10, 11, 12, like Airbnb and Uber are, giving some secondary opportunities in the 5 to 10 year window so people who are fully vested have something and they don't leave the company makes sense, right? But even then, you want them selling 10% or 20% of their shares, and you want to mitigate it. This is
and in that case, I think so that's my gets into my second point, which is you touched on, Jason, capital going to the company. Ben, you did too. Capital going to the company versus capital going to the founder. Like the point of raising an early stage financing, if you're a founder, if you're like a purely rational founder, is like you are taking on capital, you are selling equity, which is painful to you, to get resources that you need to build the company and grow it so that the value is greater in the future that you own. That's not what's happening here. And like this use of capital, if anything, is neutral to the business and potentially long-term detrimental to the business.
Yeah, so there you have it,
there's
folks. Go ahead,
double upside that an investor gets by investing. They get the upside of now I get to own a material amount of this company, and this company just became more valuable because now it's capitalized. And in this situation, it only has the one benefit of now I get to own shares in the company.
Yeah, and this is one thing that I think we can't, you can't discount, is that when Andreessen Horowitz's name or Sequoia's or benchmarks on a company, it does get more valuable. I would say, generally speaking, those companies become twice as valuable with those names on it. But having been
you've lived it as a Sequoia founder, right?
Yeah, and what happens is after you raise that money, your phone rings off the hooks from all the Series B folks. Like there are firms, I think DAG is one, and others that were known in the Valley as, looking at the top tier firms and then providing the Series B, and they were kind of constructed that way to be the follow-on capital before those funds actually had follow-on funds, before anybody realized put that all under one roof. But the problem is, and having raised $100 million for Mahalo right before we launched, so I was in the exact situation, is you have to then go fill in that valuation. I didn't mean to flex. It's not meant as a flex, but I did the same thing. I raised our Series B before.
So what are you hating on this for?
Oh, I'm not hating on it. I'm bringing it up as a topic of discussion, right? And that's why
how did that impact the company doing that, raising that much money?
It basically gives you 5 years of runway. which is dangerous and amazing. I think it did take a little of my focus off because I worked on too many concurrent things, right? And so having less capital might have increased the amount of success. But it did give me the ability to take 3 swings at bat and try 3 different businesses, the third of which is Inside that I'm still on. We basically did the web startup, we did the YouTube video stuff, and both of those didn't really work out. One, we got clobbered by the search engine changes that Google made. The second one, YouTube, just didn't seem like a great business to be in. And then Inside is still going, and it's doing moderately okay. So we'll see. But it is a dangerous thing to do in terms of you have to fill in the valuation. So if you're confident, that's not really super dangerous for the founder. It just requires a lot of discipline, which they seem to have. These are not first-time founders. So giving them $10 million doesn't mean they're going to go buy a huge office space and, Ferraris with their secondary. I get the sense these are much more mature folks who will put that to good use. All right, when we get back from this final break, we'll talk about Facebook buying GIPHY, SoftBank's ginormous loss, and Uber's layoffs and the GrubHub acquisition, as well as Twitter and Square saying, the Jack collection of companies, the Jack cohort, saying work from home forever. And maybe AMC is going to buy a movie theater chain. That's an interesting idea when we get back on This Week in Startups. All right, if you're a business owner, and chances you are, since you are listening to This Week in Startups, you're reevaluating the way you do business right now. Establishing your online presence is no longer optional, it's necessary, and pivoting quickly is hard enough. But finding the people to make it happen, well, that can feel like a full-time job. And Fiverr's freelancing platform helps you find the right talent to build your online presence fast. You can evolve, adapt, and grow your business with Fiverr. They'll connect businesses with freelancers, offering hundreds of different types of digital services, from graphic design to copywriting, web programming, film editing, voiceover, music, and more. And you know what? One of the things that's great about working with these Fiverr freelancers is that you learn a lot working with them, and they're really good at educating you on how to make better copy or better designs. And we've used them many times for research. We want to meet 1,000 founders, let's say, when we're going to Sydney. Well, having somebody do the research and read all the newspapers and magazines and blogs and social media and find all the accelerators, but we got somebody to put that all in a nice spreadsheet for us and organize it so we didn't have to do it. Then we start on second base. That's what you want to do. You want to augment your team and you want to get things done quickly with Fiverr. It's really easy to use. You basically can search, and you can search by the deadline you have, because some freelancers are not available today, but other ones are. And you know exactly what you're paying for up front. There is no negotiation and no time wasted. They have 24/7 customer service for any time you have an issue. Fiverr is there to help you. So find talent today at Fiverr.com and receive 10% off your first order using the code TWIST. It's Fiverr.com. 2 R's at the end. Fiverr, Fiverr.com. And you'll find all those great digital services that you need at Fiverr.com. Use the code TWIST for 10% off your first order. It's a really great service. We use it here, and you're going to love it. Okay, let's get back to this amazing episode. All right, breaking news as we're sitting here. Joe Rogan's podcast is becoming a Spotify exclusive, which is a massive gain. Reading from The Verge here, Joe Rogan, comedian and host of one of the most popular podcasts in the world, no duh, is taking his show to Spotify. Joe Rogan Experience will soon be a Spotify exclusive, meaning episodes, full audio, and video will only be available through the platform starting later this year. Up until now, Rogan's show has never been available on Spotify, let alone exclusively to any platform. The show will become available on Spotify globally starting on September 1st, and it will become an exclusive sometime after that point. Listeners won't have to pay for access to episodes, but they will have to become a Spotify user. Spotify said in a press release that Rogan retains creative control of the show. It didn't disclose how much it spent on the deal. The company will also work with an ad agency to jointly sell ads against the program. Rogan said last year his show reached 190 million downloads a month. Rogan's YouTube channel will remain live, but it won't contain full episodes. There might be clips and other stuff. Wow, that's a big loss for YouTube. This is a massive get for Spotify, according to The Verge.
This is huge.
It's huge.
The fact that it's not going to be in the YouTube recommendation algorithm anymore, where it's not going to sort of bubble up to people who are watching other. That's amazing.
I think
it's still going to be clips. Clips are the value of YouTube.
Just clips.
That's the value of it, and that'll just drive more people to the long form episodes. But I'm going to guess, if we had to guess this deal, it'll come out eventually because Spotify is public. I am going to, everybody start thinking about a number per year in value. There have been public reports of 30 million or so. somebody did like a back of the envelope and said the podcast was making 50 million, which would be $1 million a week, which would be like $250,000 per episode. I don't buy that. I would say if he was doing 100K an episode, is that even possible? I think the ads are probably 25,000. Maybe he's got 4 ads.
The ads are still happening, right? You said
yeah. So the ads are going to happen here. They'll be sold. I'm going to say this is a. Well, maybe they're paying him a guarantee on the ads. So maybe they took whatever his advertising is and doubled it. So if his advertising was in that 30-40 million a year range, I'm going to guess they're giving him 75 million a year for 5 years. So put the total deal value at 350,000 for 5 years. And we don't have the duration of it, but I can't see them doing this for less than 5 years. So I'm going to say 5 years.
What's Stern's deal with the series?
I think it was 200 million a year at the peak, and then he went to 3 days a week, and so they lowered it. So I'm kind of using that also as a possibility. So I'm going to go ahead and just say I put this at 75 million a year, which is 375,000 over 5 years. So I'm going to put the duration at 5. I'm going to put it at 375 for the total value of the deal. You guys want to take overs or unders, or make your own speculation of the value of the deal?
I'm going to go under. My original thought when I saw the news flash was that it's in this 200 million category along with The Ringer.
Which was bought and owned outright now, right? They own it outright.
Exactly. Yeah, this is an exclusive partnership. I think it's less than 3 years. I think your price per year is a little high. I think it's 60 million a year, and I think it's a 3-year exclusive deal. So
I think it totally depends on how the deal was structured, but I bet there's a guaranteed cash payment of, probably a cash payment on top of everything else. I bet in the 10 to 30 million a year range, just for like being
that's
exclusive.
what I'm thinking. Like if you had 35 million in ad sales, now they're taking that over. Now we have the $30 million.
Well, yeah. So then I think on the ad upside, well, there's two interesting things here. So on the ad upside, I bet they're doing revenue share on the ads, and the promise is they're going to pour a lot more resources into it. And Spotify this is what they've been building for the last couple of years with their whole podcasting strategy, is an actual coherent ad platform for advertisers.
Where's Spotify? Hey man, where's my fucking phone call? Let's go. Let's make this startups a Spotify exclusive.
Let's do it live. Let's see if we can get it on the air.
Come on, Daniel.
People don't realize Spotify has been doing this with podcasts of all size, like even tiny podcasts. They're taking them. Yeah. They're taking them exclusive. Yep.
I'll be a Spotify exclusive. Sure, why not?
It started.
If I can still own my show and I still control. So that's the thing, is they don't want to. I think the reason they did this podcast this way and they bought out The Ringer is The Ringer is controllable and it's PG-13, and it doesn't have.
It's also a network of shows.
It's a network of shows. It's a platform. It's more than just a single individual. But in this case, the single individual could be so polarizing. The guest could be so polarizing, and you're not controlling Joe Rogan, right? And he's going to say things at some point in a comedy show that'll make people try to cancel him on Spotify. Well, there'll be a moment where they'll try to cancel Spotify because he has Alex Jones on, right? And so
that's only going to be good for Spotify, though. I mean, like the same way
this is what Spotify is buying. Spotify just
Sirius.
bought a huge headache, like the same way SiriusXM had to manage the Stern relationship. And maybe Stern actually toned it. I don't know if he toned it up or down. Ultimately, I think
he's definitely become more enlightened over the years.
Well, yeah. I mean, I think that's his personal journey. I wonder if that is because Sirius wouldn't want to have the ad backlash, but they're subscription based, so that doesn't make sense.
Well, okay, so but here's the. I don't know if this happened. I'd be super curious. I wonder if there's a part of this deal that is tied to incremental Spotify subscriptions that are
which is what Stern probably had, right?
Yeah. How do you do that attribution though? That's going to be
it's very simple. If the person listens to more than 5 hours of Joe Rogan and then subscribes, but they weren't previous a subscriber, you give him the first month or 2 months of that subscription. Very simple.
So much money. I mean, the subscription business, like this is at some points, but like Ben and I know one of the companies we've started together is Glow with PSL and the team there. And we run our LP show on it. Subscription business model and the podcasting as a media model go together like, peanut butter and jelly. Like
you do have to pick
shocking
one.
that the big podcasters have not done this yet.
Yeah. I don't know if Joe Rogan would work as a subscription-based product, but I do think they could do.
Do what we do on the LP show. It's like half free,
extra.
Half paid.
See, I don't think that really works that well. I think you have to be majority. Oh, you're half and half? Yeah, I think it has to be majority. Like, I don't know if you watched Sam Harris, but he's at, I think he does 30 minutes free, and then the next whatever, it's typically, over an hour's podcast, you get sent to the paid feed. And he controls it all himself. He's not on Patreon anymore. He's his own subscription, dedicated. He's a personal friend of mine, and I actually pushed him into podcasting. Long story, but
yeah, didn't he come on your show as like his very first?
Yeah, I mean, I basically was
he bought you a
he was
bottle
like,
of
how do
wine.
you? Well, no, we were having dinner one night, and Sam was like, "What do you think about me doing a podcast?" I said, "You're built for it. Like, you're an incredible conversationalist. You and I and other folks have sat there until 2 a.m. talking about like really heady topics, like, we have the same book agent, John Brockman. So myself, Sam Harris, and some other folks are all like kind of run in that same circle. It's like a bunch of like really smart scientists and then dipshits like me who get to tag along. Anyway, long story short, I wonder if they're going to make a run at Sam Harris and those people next. And then we got to see if how Spotify is going to handle the backlash.
100% they already have.
Yeah, they're probably doing this through CAA. CAA represents a lot. I talked to the CAA guys about repping me, and I don't really do enough, I think, to make it interesting. But we're sold out as a podcast, so I mean, we're low millions of dollars as a podcast. Would I do it?
All advertising?
All advertising. We did a Patreon, but you know what? We produce so much content.
Oh,
typically 3 episodes.
That's not the way to do it.
I just tested it, and I'm thinking about shutting it down. We did like an ad-free version, and I like what you're doing, but for me, I want to make my money by finding the next Uber, not off the podcast. So I keep putting, I think we spend 10% of whatever we make promoting the show. So we've been doing advertising of the clips on LinkedIn and Instagram and other places just to get more people into the show. So I'm looking at this long term, but I already made my nuts. I made my bones. Like, I think Joe Rogan, like, this is like his big score. This is his Uber. Like,
this is very much like Ninja going exclusive with Mixer. It's basically, it's Joe Rogan's exit, where he's taking sort of
a soft
big
exit, right? And he still owns it. Podcast One did this with Adam Carolla. They gave Adam Carolla, I think, $20 million a year for his shows.
This is huge, though. Spotify.
This is so big for the industry, David.
Spotify is so much better positioned than any other podcast player.
For sure.
And because the business model is total. Well, Apple. This is like Apple's biggest strategic mistake of all time. Second to firing Steve Jobs. Well, they controlled the whole ecosystem. It's called podcast because of the iPod.
Yeah.
And Apple controlled everything, and they just refused to show any interest in it. We're a hardware company. This is not core to what we do.
And we won't buy companies.
Music sitting right there.
Like, they could have bought companies. They bought a podcasting company I was an investor in called Swell, which was like the best podcasting app of its time. And I think we doubled our money in like a year, and I begged the founders not to sell.
But they shut it down right after they
shut it down. Yeah. Swell was just brilliant. They used the card metaphor, sort of like Tinder on your app, and you would swipe forward. It would just show you a podcast. You'd start listening to it, and then you'd swipe forward at some point and get the next one that was the next most interesting to you. And if you were on Joe Rogan and you got 2 minutes in and you went forward, but then you were on Acquired and you went till, the end of the episode, well, they're not going to give you another Joe Rogan, MMA, whatever, general interest podcast. They might send you to This Week in Startups, right, as the next one in that stack. And then if you listen to that one for a long time, they might send you to 20-Minute VC or whatever. They would take you down the rabbit hole. And what a mistake. And this is why Apple is going to fail on TV as well, is because they don't want to ever be associated with controversial content. And this is where I think Spotify can actually hold the line, because they're independent. If people don't like it and they don't like Joe Rogan's content, Spotify would just be like, yeah, don't buy our service. Just like SiriusXM, like as an independent
or just
company.
don't listen.
Don't listen.
Well, so here's what I think is different. The problem in podcasting, everybody kind of like Swell thought it was, and Breaker and lots of other folks thought the problem in podcasting was a discovery model. There's no discovery problem in podcast. Like, how many people do you know that are like, oh man, I wish I listened to more podcasts. If anybody,
I can't find a podcast to listen to is something I've heard from nobody.
Nobody. The problem is monetization. Like, there's no good interface for advertisers other than email and you guys
making it sustainable.
Us.
Yeah, making it sustainable as a model. And this is YouTube's. Like, this is a stupid move on YouTube. YouTube should have just said, here's some Google shares.
They should have made it work.
They should have just made it work. But here's the problem for YouTube and any of these big things. This is why startups have a much startups and independent companies have such an edge over the big conglomerates. If you're Apple or Google, and Alex Jones, as the best example, has been banned on YouTube, and then he comes on Joe Rogan's podcast. Now you've got senators, congressmen, presidents, and politicians, as well as advertisers and nonprofits going to Ivory Soap and saying, don't buy on YouTube. And then you might have, if you're Apple, a bunch of right-wing folks saying, Apple banned Joe Rogan, don't buy iPhones, go Android. Right? And it's just not worth the adjective for a big company with bigger revenue streams. Now, for Spotify, this is the revenue stream. So Joe Rogan increases that revenue stream so they can just say, mission accomplished when people start coming at Joe Rogan for being controversial.
We should talk about, for just a little brief side moment here, what a better business model podcasts are for Spotify than music is, because they get no operating leverage on music. So, Spotify gets $1 in for music, and then they have to pay whatever amount of cents out to the labels. They never get any sort of additional upside. With podcasts, first of all, most of the ones on there are free. So people who are joining to listen to content, is only upside. The ones that they own outright, that they don't have any sort of variable costs with, like, they should promote the crap out of the shows because they get all the upside on top of the fixed costs that they paid the podcaster. Amazing. So This is like, they're switching from one of the worst business models ever that they've sort of made work because, God, the product was just needed and they executed really well there, to actually finding a really, really good business model here.
So there's a person, our official #1 acquired superhero who deserves probably the lion's share of the credit for this year, and that's Barry McCarthy, who is now the former CFO of Spotify. He just retired and is now just a board member, but he was the CFO of Netflix. And through all the run of like the transition, well, I think from the very beginning,
right? But he knows that transition, so his fingerprints are on original content. And then the transition to streaming, and then the transition to original content. You know what the other really interesting insight here is? Spotify going public, doing that direct listing, and having this currency and being independent makes them so able to withstand this and make bold moves. And you look at a company like Uber now, which we'll segue to in a moment, being able to potentially make a run at GrubHub. Or, Uber could buy Domino's pizza. Like, I don't know why we're talking about GrubHub. If I'm Uber, I'm buying Domino's for $15 billion. I'm not kidding.
Call up Dara. I'm not kidding either.
No, I mean, make a clip here. Hi, Dara. You don't know me. We ran into each other in the Warriors games in the courtside club. Anyway, just, a little drop that there for a second. And I introduced myself to you, and you really seemed like you were completely not interested in the fact that I was the third investor in Uber. Totally reasonable. I'm not your problem now. However, forget about GrubHub at $6 billion or 7 or 8 or whatever they want. We need to buy as much of Domino's and do a hostile takeover of Domino's now. They're at a $15 billion market cap. They have a clunky app, but they make pizza that if you eat it when it's hot, that thin crust is damn tasty. And I hate it when it's cold, and I hate the regular one, but that thin crust can work. And people like the 24 hours. It's already got a footprint. Let's buy that. And have Uber drivers making the delivery times even shorter. In 2018, slightly over 50% of podcast listens came from Apple Podcast app. Don't know what it is today, because Spotify, I think, started to gain ground after that. What do we think in 2022?
Morgan Stanley just estimated Spotify just passed Apple.
They did. So let's go to 2022. What does Spotify's percentage of podcast listenings equal? What do you think? If it's 50% now, let's say.
It's not 50% now.
It's not?
No. It's past 50% in lots of countries, but it's definitely not 50% in the US.
Yeah,
I think it's something like 18, 19% in the US.
Okay, so let's say if it's 18, 19 in the US, what is it in 5 years from now, 2025? 5 years from now. You got this aggressive positioning.
5 years from now, I think they're over 50%.
Yeah, I think they're the Google Chrome.
Yeah.
I think they're Google Chrome, they're Android.
Today is the landmark deal.
This is the turning point, yeah.
The first one was buying Gimlet and Anchor.
They did the exclusive
Gimlet and
deal.
Anchor were like, those
Rogan
are singles
deal
and doubles, but the Bill Simmons was like the landmark deal that just got surpassed, and this is the actual landmark deal. right? We'd agree on that. This is more important than Bill Simmons.
Oh yeah,
Yes,
this is
sure.
landmark. This is like
I don't think people
bombshell.
understand how important, how big, and how just like what a behemoth audience Joe Rogan has. It's
Bonkers.
almost unfathomable that a
I
single person.
assume he's probably bigger than Stern.
He copied the Howard Stern playbook. I mean, he literally runs the podcast like Howard Stern runs the show, which is, I'm going to go 3 hours and I'm just going to talk about every topic, and there's no sacred cows, and the more controversial it is, the more we're going to lean into it.
He nailed the clips too. Like
He nailed clips for
that is huge.
Sure. So will Bill Simmons then move exclusive? Because Bill Simmons they never brought up the exclusivity thing with Bill Simmons, but why wouldn't they make Bill Simmons exclusive? And does this mean if I have the RSS feed of a show, they're going to just take down the RSS feeds of the show? So I can't use it in Overwatch either? I'm in Overcast?
They have done this in cases. See, there's this interesting nuance here, though. I'm curious to see what they'll do, because they still, because of the way podcasts work, like they still win if they let some content out there in the open, right? Because if they own it, then they're still monetizing it on other platforms.
Yeah, and it's customer acquisition.
Right, exactly. They need a front door in for people to come in and be like, oh, hey, you can listen to this on Overcast, but if you want to hear Rogan and all these other great podcasts, why don't you just jump over and listen on Spotify too?
I think what they'll do is, this is how I would execute it. I would just copy Sam Harris's model. The RSS feeds have the first half hour of every show. And at the end of that, they say, to listen to the rest of the show, go to Spotify. Can you imagine how infrequently Apple will feature Bill Simmons podcasts? And I mean, it'll literally be like
I bet they'll still feature, like Apple is asleep at the switch.
I really like it. This is one of the confounding things about Apple as a company. And I said this last year when I was like, listen, I think Tim Cook did a great job of managing. I said this on CNBC. He did a great job of managing Apple through the transition, but they need to get somebody in there with a bolder vision who will buy stuff because they have the cash. The iPhone business franchise is now having challenges. They don't report the number of iPhones sold anymore for a reason. And they're leaning into like talking about services revenue, like App Store revenue, for a reason, because people do not see the need to upgrade their phone as much. And it's just not as like, it's not as alluring of a business. It's a deprecating business now. So they should buy
this
things.
would have been the crown jewel in the services narrative.
Of course.
Would have been subscriptions and advertising from podcasts.
The problem is they'll never be able to compete with Netflix or HBO doing racy content, nor will they be able to compete with SiriusXM or Spotify now doing edgy content. Let's just put it as edgy. You're not going to have edgy content on an Apple device. They're Pixar.
And they're not going to compete with Disney doing family-friendly content.
No, and this is why Disney passed on buying Twitter. I don't know if you read Bob Iger's book or listened to it.
Yeah, so good.
And they're like, he just called Jack and he's like, yeah, you know what? We were going to buy Twitter, but sorry, no. My gut says I don't want to deal with hate speech. I don't want to deal with policing any speech, right? Or misinformation.
And Jack was on the Disney board.
Yeah, I mean, that's got to be kind of a bummer for him. Just going quickly through this, let's go with... go
to Uber Eats. I know Rosenthal's got some good dirt.
Yeah.
All right, here we go. Okay, so everybody knows we've talked about this and you've read about it. Uber is laying off 3,000 people, closing 45 offices. Those are massive cuts.
Super sad.
Stock, it's very sad. Stock went way up, obviously. People want to see these things become more sustainable. Rides are down 80%, which is what people thought would happen. But Uber Eats is up 52%. And obviously they're said, they've been seeing green shoots, and last 3 weeks things have been going up. And in Hong Kong and other places where the pandemic kind of, they're on the other side of it, hopefully, they see things rebounding. But the potential GrubHub acquisition has been a lot of talk. They've been negotiating. AOC and Elizabeth Warren came out very publicly swinging, saying we can't, for any reason, allow these companies to merge.
There hasn't even been proposed deal yet. Like, we have no idea on terms. This is like so much
anti-capitalism is crazy. Let's put a pin in that for a second. Overall, what do you think of the deal, David? Should they do it? Right. Should Uber do it?
Jason,
at $6
you hit
billion?
the nail on the head. This whole thing is a quagmire. This is like a land war in Russia. Like, you're dealing with regulators, you're dealing with the government. Like, for what?
Get Bill Broder in here. It's red notice. Yeah.
For a business model that is very challenged. Like
super challenged.
Super challenged. Like, think about it. Like, consumers don't want to pay more than $5 or $10 more than the price of food to get it delivered to their door, right? For the price of the food plus $5 or $10, now you got to do all of this stuff. You got to get somebody, 45 minutes to an hour of their time plus transportation to go drive to the restaurant when the order comes in, sit there, wait for the order to be ready, mob the restaurant. So like if you've got a dine-in business that's going on and now you've got 50, DoorDash and Uber Eats orders, drivers sitting outside, good luck retaining your dine-in customers. Not to mention now you got to employ somebody else at the restaurant to deal with all this. The business model doesn't make sense.
So for a restaurant to do this themselves,
makes sense.
Yes, but for a restaurant to do it themselves, I've been getting pitched. I'm sure you guys have as well on companies that are building software,
white label,
yep,
totally.
And I looked at that, and I'm going to invest in one of these. I think if you have one of these companies, email me please because I would like to invest in one. I think that this is going to be the backstop, and people are going to have roll your own app. And if you have more than 10 stores or you have a loved store, people will download your app and they'll want to use it. I think it's going to be a good business and they'll make $500 a month or whatever it is, as a SaaS fee.
Yep.
But for everybody else, their business is not going to be able to sustain rolling their own app, enterprise software, et cetera. They should, and they probably appreciate paying 30%.
Yep.
To have
so
this
this is what GrubHub and Seamless were before all this craziness happened. Like people don't remember. Jason, you probably remember Seamless back in New York. It was just an online ordering platform. They didn't do any of the delivery. No. Like that was all up to the restaurants to figure out the right way to do it.
They had runners at the restaurant. So what they would use is they would first they might have one dedicated, because I grew up in the restaurant business and I'm from New York. Typically, the way a small restaurant would do this is they would have somebody who would sit at the bar who would do deliveries for, $5 plus tip, and they would just hang out there. They were kind of like the original gig workers, and it was typically like somebody who was kind of out of work. They just got paid under the table cash. So the bartender would give them $5 to make the delivery. If they made an extra $3 or $4 on the delivery, they made $8, and then they would probably spend it at the bar having a beer, and they just hang out there. And it was just like side cash. It was a side hustle. Then you would go to the dishwasher or the busboy, the waiter or the owner, if that person was out making a delivery. That's how deliveries kind of worked. You had your own like mini gig economy going on at the bar. Now it's really interesting. I had the founder of The Slice. He has a service that's super competitive. And what I thought was ridiculous about trying to stop this deal is if you look at the market caps of these companies, it doesn't include pizza. It doesn't include Domino's or Slice. So they're talking about these 4 companies and the market cap of these 4 companies as if that's the TAM. This is why like people like AOC or Elizabeth Warren trying to opine and come up with a rule book for capitalism is so insane. They think that they're so uneducated on topics of business that they think the TAM is those 4 players. So they're like, we can't have those 4 players go to three. It's like only 30% of people have probably ever used these apps.
Yeah, so there's an issue here where not only is, and this is the same argument that Zillow made when they got to merge with Trulia, it was hey, the world is not online lead generation for real estate agents. The world is lead generation for real estate agents, of which we are this tiny little percentage of.
Yes.
And so for restaurants, it's not app-based food delivery, it's all food delivery.
Yes.
The issue with this whole app-based food delivery concept is, David, you're exactly right. What Seamless and GrubHub were doing before the money rushed in seemed to be a sustainable business model. I mean, these companies were profitable, they went public, but since SoftBank has rushed into DoorDash and since Uber has done their Uber thing and raised the money they raised and launched Uber Eats, like we now have a product in market where we don't know if it has product market fit because it has never been available at the price where the business can continue and cover their costs. And so like the experiment has not been run in the last 5 years of do consumers actually want app-based food delivery in this way? Because we have no idea.
GrubHub and Domino's did.
Well, so the GrubHub CEO in Q3 of last year, I think they canceled their earnings call and he wrote a letter to shareholders instead. And he laid all this out. And he says in there, he says like, look, we've been doing this for over 10 years. We've always concluded that the logistics portion of this, like what yes. Uber and DoorDash brought in, married on the logistics, is a commodity. It is not possible to operate profitably while doing that. we are going to do it because we must to respond to the competition.
That's interesting.
And then at the same time, you've got Dominos sitting over there, which is architected soup to nuts to be a delivery business. I invested in this company called Private Chef Club that came out of Uber, early Uber folks. That is this. It is architected soup to nuts.
Private Chef Club?
It is, it's like good eggs for groceries. Private Chef Club is for dinner. And it's exactly what it sounds like. They have some of the best chefs in San Francisco. They have their own kitchens. They have a hub and spoke model. They get all the orders come in advance. There's no food spoilage. And the delivery, instead of, the GrubHub or the Uber Eats driver, they go to the restaurant, they wait, they pick it up. It all happens in a line. So it's like you go to the spoke, you pick up 10 meals, and you drop.
Yeah.
And it works.
Yeah, we had a company like that, Bento. It didn't work. They were trying to do the on-time delivery, but then they tried to do scheduling. And there's been a ton of swings at bat here of people. And there were also, what were the other like single meal delivery ones? There were like 3 or 4 other ones.
Sprig.
Spoon Rocket.
What was the other one?
Spoon Rocket.
It's worth calling out. And David, in his research for this last night, pinged me and was like, if this was an acquired episode, I would totally talk about how Uber Eats actually started as a Sprig clone.
It did, yeah.
Do you remember that, Jason? They used to drive around. David,
oh, that's right. They put a certain number of meals in the trunk, and they would drop them off.
Kept them warm.
Kept them warm and dropped them off. Yes, I do remember that. Yes, that was Travis's original experiment. Because it would be
DoorDash
faster.
arrived on the scene, and then they were like, "Oh no, we can grow way faster if we just do delivery from restaurants."
I mean, it's pretty clear people will pay for this. You might lose the bottom 10% if you charge what it costs, but
wait, I want to dive into that though. I think that our whole industry has a problem where it's not product market fit; it's product market price fit. And
product market price fit. Okay, yeah, unit economics work is basically what you're saying,
right? And that is not being tested right now. We are testing product market fit without the third missing component.
Well, I mean, if a restaurant made it work and GrubHub made it work, there's a way to make it work. The question is, how many consumers have access to it? Because it might be a little expensive. It might be $10 to deliver your food, in which case picking it up makes more sense, right?
Right. And I guess my argument there is like it's a different market then. Like
it's a different product. But it's just like ride sharing, right? Like if there's only one company, it's not Uber and Lyft, well then prices are going to go way up. What's that going to do to demand? We don't know. Right.
And it might be actually the experiment here to your point might be Uber Pool and Lyft Line sharing the car just might not work as businesses. It was a worthy experiment to try for a while, but it actually may not work, right, Ben?
Yeah. Exactly.
But we know the ride sharing does, and we obviously know Lincoln Town Cars do. So for high-end people doing delivery and paying $10, $20 in fees, it doesn't matter. But I have to say, I look at the fees, and we have a cloud kitchen across from our office, and I walk over and get my Bel Campo burger myself. And I just pick it up from a locker because it doesn't make sense for a car to drive around the corner.
Well, Travis figured this out, years ago too, right? Which is that like the Eats DoorDash model is not the most evolved food delivery model.
You need to have a hub.
Yeah, you need to have a hub and spoke. And he got in on the real estate side of things, but like there are going to be tons of, I think actually Sequoia wrote a big piece about this. There are going to be tons of new companies started that are restaurants built on top of this infrastructure. This is what Private Chef Club is. That are their own companies and brands that are just architected soup to nuts to do this.
And this is why it's so idiotic for a bunch of politicians to come in and say, let us put our thumb on the scale. Let us try to pick winners. Let's put some regulation on this. When the free market is so cutthroat and hyperactive that consumers are getting services below cost for 5 to 10 years to then make these systems so efficient that they can actually exist in the world because they're at scale. If politicians had their way, they would have stopped Amazon Prime. They would have said, we are going to stop anybody from having 2-day delivery. And we're going to stop Costco from not charging a profit and just having a membership fee because those things are anti-competitive with local stores. Do you want consumers to live in a world where they don't have access to Amazon Prime and Costco? I don't. The reason we have much more food security in the world is because a company like Costco can provide massive amount of calories and I think they sell their food at a break even, right? And they make money off the membership. Isn't that the business model? I'm 90% sure
they would argue that it's like, we make money in a bunch of different places, but if you look at their 10K, like roughly subscription revenue equals net income.
Basically, yeah. And so, this is why we have to really think as Americans. I was on CNBC earlier this week and I kind of went off and I was like, as Americans, we have to decide. Or
shocked, Jason.
Well, I was like, listen, we have to decide, do we want to have a free market and let all these entrepreneurs creatively battle it out and see what's left after a decade-long dogfight? Or do we want to have a bunch of socialist maniacs who've never worked a day in their lives define the rules of capitalism from the bleachers? They've never been on the field. They've never done this. They've never built these companies. They've never innovated. And now they're going to say, let's come up with a new form of capitalism where nobody can be capitalists anymore. And there'll be no more free market for people to battle it out. This is a vibrant, amazing market. Let these companies consolidate and be sustainable. Look what happened when San Francisco said they were going to cap fees or whatever. And Uber's like, yeah, we're not going to Treasure Island anymore. Not profitable. I don't know if you guys saw that. Did you guys see that they put a cap?
No, I didn't see that.
Yeah, they put it was like when they were in Austin, they were like, if people are going to be driving ride sharing, we're going to make it impossible for you to do that. You have to go through all these hurdles. And Austin lost ride sharing from Lyft and Uber. Like, okay, we opt out. And they made Austin
great. This is
rideshare.
going to be your Chamath moment on CNBC.
No, honestly, I mean, it did go a little micro viral or whatever, but I think I don't want to. The easiest way to go viral is to do what Chamath's doing, and he does actually believe this, which is if you just champion the poor and you champion the downtrodden, you'll just go viral. But this is a much more nuanced conversation that capitalism ultimately leads to gains for everybody. I believe that. If you don't believe capitalism ultimately provides a better result for the human species, well, that's a different conversation. But I think all of us here agree that capitalism, as flawed as it can be on the edges, ultimately results in products and services that are cheaper, better, and more accessible.
Well, I think the problem is it's so tempting. Even VCs and entrepreneurs fall into the mistake. It's so tempting to look at markets and be like, the way things are is the way things will be. Like, no, there's always going to be change. Like, and as long as there's always change, whatever, like it wasn't the DOJ that killed Microsoft. It was the web that killed Microsoft's back better than ever. Like, it was mobile.
Yeah. And they missed it. I mean, look, we started the whole first half of the show talking about this crazy outlier funding of a startup that's not even launched yet to the public. And then here we are on the back end, like we have to create rule sets. Like this is a vibrant, crazy market that takes insane risks to change the world. That's why we punch above our weight as America. And that's why we're super innovative. That's why we're not getting demolished by other countries. That's why most of the companies that change the world come from America. Because we run the most experiments, we take the boldest action, we try the craziest ideas, and we're not afraid of failing. And we don't create a game with so many rules that the second you get on the court, you get a ticket, right? Like, you ever watch a basketball game and they're calling fouls every 2 seconds, and you're like, guys, just let them play. And the announcers are like, they just got to let them play. Like, that's not a foul. Like, let the entrepreneurs play the game. Let them play the goddamn game, and the magic will happen.
Well, I think what we need is we have it to a certain extent, but we need more of a kind of safety net. Ironic, given what we were talking about with the secondary earlier, but a kind of safety net underneath. Like, how many companies have you started, Jason? 4 or 5?
Yeah, myself personally.
Launch? Yeah.
6 or 7, I think. Yeah.
Because not all of them were successes, right?
No, like 2 or 3.
Yeah, right. I mean, same for Ben and me.
Yeah.
Like, but that's the way the Clubhouse guys, like, they started Highlight. Highlight wasn't a success, but they're back at it. Like,
keep going.
That's what you need.
Absolutely.
You don't die if you fail.
Who's going to win? If we had to pick a winner 5 years from now, give me the ranking. Let's just, we have 4 major players: GrubHub, DoorDash, Uber Eats, and Postmates. Those are the big 4. Which one is most likely to not exist, to get subsumed, and then rank the other 3?
Well, Postmates will get subsumed.
That's a given.
Or continue as a small business. Like,
right.
At some point, someone will make them a takeout offer that they're interested in.
Sure.
Uber Eats will win because I don't believe the 3-sided marketplace of restaurant, driver, and food orderer can work without the sort of like available spike capacity on the driver side that Uber can offer.
Got
so if
it.
you think about DoorDash's model, if a whole crap ton of people suddenly want food at once, but then for many hours nobody wants food at all, like they don't have any way to absorb that cushion in the same way that sort of Amazon uses UPS for cushion. But Uber conveniently has this other set of drivers that are sitting around
Yes.
willing to go from point A to point B.
Yes.
So I think Uber has the superior business model.
So Uber, DoorDash, and then Postmates and GrubHub maybe get acquired, is your thinking?
I think so.
Okay.
I think it probably all consolidates down to one, especially because most of, one of the other topics was SoftBank, right? Like, I believe SoftBank is the largest shareholder in DoorDash.
No, they were pushing like a $10 billion merger
Right.
with Uber and DoorDash, which for
I think it was a
Masayoshi
16
style.
post on the last round, so
ridiculous.
yeah,
Yeah,
haircut.
yeah, that would be a super haircut.
So assuming that there's no more funding of that scale available
There
for
is not.
DoorDash,
Yeah,
that seems like a given,
that's a given.
right? And to continue operating on the status quo, their runway is, measured in low single digit years. That's not sustainable. So
Right. No, DoorDash has got to make a move now. So what do you think? Who wins ultimately? Who's number one? Who's number two? Which brand at the end of the day is left standing? Number one and number two.
I think it's probably Uber, unless for some reason they decide that actually it's better to consolidate under DoorDash. But that doesn't make sense to Ben's point of they have a supply
So
advantage.
Uber, DoorDash is yours? Your order?
Oh no, I think DoorDash. I think everybody gets acquired into Uber. GrubHub, Postmates maybe pivots or does something else.
Here's what I think happens. Uber, GrubHub, number one. Then I think Lyft and DoorDash merge, number two.
That makes sense.
And then you have two players with both, because Lyft is learning a hard lesson right now about having a single dependency as a revenue stream. And
Lyft and hundreds and thousands of other companies around the U.S.
yeah, of course, right? Yeah,
Or the world.
Well, we always say focus, right? Like, stay focused, and then you realize, like, oh shit, I was so focused on advertising. BuzzFeed was focused on advertising. New York Times was focused on subscriptions and advertising, and now BuzzFeed is going to, I don't know. I think they're going to lay off half the company in the coming weeks. That's my best guess, is that there'll be half as many people working at BuzzFeed in Q4 than there are at the Q4 last year. Half as many, maximum. Because they're an ad-based model. I can tell you, just looking at the ads, across the board, if Facebook and Google ads are 30% off right now, I don't know if you're hearing that from your portfolio companies, that there isn't as much demand, so they're maybe 20, 30% off. If that's happening to the top two players with the best data, the best platform, the best tools, et cetera, the ability to scale, what is happening at BuzzFeed? What's happening at Vox? Like, those places are not subscription-based. They don't have content that's, I'm not saying this to be mean or anything, but it's not content that people would pay for. It's
not architected in the right way.
It's not architected to be that way. Yeah. So the whole architecture of the business, Vice I would put in that as well. Like, I think Vice, Vox, and BuzzFeed will be half the size at the end of this year than they were at the end of last year to survive. I think they'll survive, but there's got to be some consolidation there. What happens there, do you think, in those at-scale media companies?
Continue. I think consolidation is the right way to put it. There's a chasm. There's just a chasm in the media business model where either you're a kind of indie shop or you make it to New York Times. I'm not saying you have to be that big, but the other side of the chasm, and there's no room in the middle.
I think Vox has the best chance. I think Vice has the least chance. So I say Vox.
Yeah.
Vox is the best run. I think Vox will roll
with
everyone
Netflix
up.
and YouTube.
Well, I know Jim Bankoff. He bought Weblogs Inc. For AOL.
That's
for
right.
me. And so Jim is just a good deal maker and, I think, a good steward of capital. So I could see Jim Bankoff. We should get him on the pod, by the way. Let's do that, Nick. Let's invite Jim Bankoff on the pod. I think he'd be a good steward of capital. And I think he's been able to manage multiple brands, which is what he basically learned from Weblogs Inc., because we used to have a lot of conversations about this, is how do you keep the Engadget team, the joystick team, the blogging baby team, the Twa team, all these different teams producing great content, even if there's overlap. And I was like, just do what Condé Nast did. You give them their own floor in the building. Like, they have their own culture. And Vanity Fair might have a take on George Clooney that Vogue has a different take and the New Yorker has a different take, and they might all want George Clooney for an article, and they might all get him at different times in the year. But you don't want one person writing the George Clooney article and syndicating it to all three brands because they all have different takes. And it was like, we used to have these like long conversations. I don't know how Vice gets out of this. That seems to be done.
Well, I mean, like everything, all the trends are just accelerating, and like how many consumers are going directly to web properties to consume content anymore?
It's really tough. I'm moving inside more into the research side. So, we're like the idea behind the newsletters at Inside were always to be very focused, not a lot of spam, a lot of data, and worth paying for. And we really have been leaning into getting people to pay for it. And then I'm just like, you know what? Journalists all want to write, like all the journalists now, this like previous to Gen X, they all want to do what do they call advocacy journalism, right? They want to pick a position and then they want to just work at MSNBC to take down Trump, or they want to work at Fox or some right-wing Breitbart to take down Hillary, right? Like they all have this very, pick an angle and then go at it hard and, facts, whatever, like anything else, you're going to build your case. And none of them want to actually do hard research. None of them want to do like the middle of the road stuff. And so I'm like, you know what? I'm just going to stop hiring journalists because this next generation of journalists, they care more about who they're attacking or who they're taking down or who they're pumping up than they do about the search for truth and knowledge and understanding.
Yeah. I mean, there's a generalization in there that I don't think is totally fair, but...
no, unpack it then, please.
Well, okay, so here's what I think is going to happen to all the talent in journalism. The best people at all these publications that are not on the crossed side of the chasm, that are in sort of this like, we raised money or we grew our head count and crap, we're not going to make it. The very best people are going to get offers from the New York Times. They're going to get cherry picked until these companies whose value is really based on what's the future stream of content that's going to come out. And without those writers, it's not going to be high. So you'll have people getting picked off the same way that Axios picked off some of the best people to build that institution.
Yeah.
Although I do think Axios is in the middle too. I just think they're better run than some of these others.
Well, if you look at them, like they're definitely not trying to do opinion. If you look at Vox, they have a very like strong opinion-based advocacy. I would put Vox in advocacy journalism. I put Axios in, I'll call truth journalism. Like let's report the truth, as opposed to or middle. Yeah, what would you call it? Like just people who want to report the truth, or knowledge-based journalism and I don't know. Journalism that makes you smarter. Like I think the other ones, Vox, like they have a position they want to take. BuzzFeed feels like position journalism at times to me.
Yeah. And then I think the other thing that's going to happen is that you're going to see more and more of these people who've built a personal brand go indie.
Yes.
And so you look at Polina from Fortune, who wrote Term Sheet for a while, like started her own email newsletter, charges for it.
Substack.
Yeah. And I think that's going to start happening more and more and more, where you're going to get this bifurcation of the best people are either going to flip to indie if they have the personal credibility and the runway personally to be able to pull that off over the course of the next year. Otherwise, they're going to get picked off. And then you're going to have, B and C players that are left. And not all B and C players. That's a sort of broad generalization. But in general, the talent's going to wither at those
non-branded, right? Non-branded talent, unbranded talent, right? So it's sort of like the podcasting space. If you want to do a podcast from your, bedroom or whatever, and you don't care about making money, great, go for it. But, it's going to become a hit-based business, and you don't need to have 50 people's take on, I don't know, the tech industry in China, or, you don't need 50 stratecheries. You need a really good stratechery and maybe a second, right? But if you look, the information, Axios, hopefully what I'll get done with Inside, where I'll just hire researchers and teach them to write if they need help with writing, but no more writers and teaching them to research. Because the problem I've had is I find journalists, and they haven't read any books about business. You and I would be like, if I just listed top 10 business books right now, if I said, did you guys read Lean Startup, Bad Blood, Crossing the Chasm, Good to Great?
Right.
It's like, yes.
Poor Charlie's Almanac, all of them.
I've read all of them.
7 Powers, yeah.
7 Powers, yeah.
I try to... I literally ask a journalist
They've
to read
all
one
been
of those
on
books,
our show.
and they're like, I asked journalists to read like Lean Startup, and they were like, will you pay me to read it? And I was just like, holy fuck. Like,
There's
literally
great
do not.
journalists who have read that. Like, I bet if we call up Brad Stone at Bloomberg,
Oh no, Brad Stone. That's a Gen
Brad's
Xer. That's Gen
amazing.
Xer. Right, I'm talking about this next generation. They literally are anti-capitalist. They're anti-business, and they don't read business books, and they hate business.
But that's the thing is like, and then what makes your show, what makes our show work is like, we're the journalists now, but we're also the practitioners.
Yes, the experts. It's sort of like Balaji was sort of pointing out about what we do is an expert having their own medium and unpacking for 90 minutes like Sam Harris is doing, or Joe Rogan does for comedy or UFC. Like, it's not citizen journalist, because citizen journalist connotes it's a citizen who does acts of journalism. This is expert journalism.
Expert, yeah.
And it's an expert saying, I'll learn how to be a host. I might not be the best journalist. I might not be the best host of a podcast. I may talk over the gas, whatever. I may be rough on the edges. But I do this this is my day job. So I have better access and better insights than
Tim Ferriss has done this better than anyone.
Yes.
And there's a cycle. Like, then they do it for a while, they get better at it, then they don't talk over the guests, then they're able to weave narrative in, then they become an imaginative storyteller. Like, these things can be learned on top of a base of domain knowledge.
Learning the domain knowledge much harder than learning the skills of a journalist or a host of a podcast, basically. And you know what? Who said this was Jason Ponton, who was running MIT's technology review, said he gave up hiring journalists and trying to teach them science and hired science graduates and taught them how to be journalists. And that's why he was able to cover nanotechnology or biotechnology, is because he was like, it's just too hard to teach a writer to do, to know some vertical. Okay, going around the horn really quick. Any thoughts on Facebook buying GIPHY for $400 million?
Ben's got a story.
Nice bailout.
Okay, explain.
I just think, I don't think this is a super hot take. It's not this like data acquisition that is this amazing silver bullet that, oh my God, now Facebook has these deep data hooks into all these organizations. If you really dig into what they got there, the data wasn't really anything they didn't already have. But GIPHY provided a valuable service. Tenor was really only the other competitor out there. Facebook had effectively taken a dependency on GIPHY, and as had many other services. So if it went away, that would have been bad. They didn't have a sustainable business model, even though they'd done a lot of work trying to do sort of licensed content, promoted content. And when I think they were either raising their next investment round or in talks with Facebook about whatever their normal partnership discussions are, I think it just sort of became something where Facebook figured, probably a good thing for us to own this so it doesn't die or get owned by someone that we don't like.
Yeah, and they had raised...
their last post was at a 600, so it was a haircut for the last round investors.
And somebody was tweeting, they had been part of a crowdfunding site that was like an AngelList competitor that went under. So Matt... Hoggy, I think is how you pronounce his name. Anyway, GIPHY was bought by Facebook. I was surprised since I participated in their early investing experiment through AlphaWorks, which was like I think an AngelList competitor, but never got any emails about this. In July 2014, I invested the minimum of $2,500 in GIPHY. I want to show you how this investment panned out. Congratulations, you're now an investor in GIPHY. GIPHY did another round in 2015, and in total they raised $72 million, but sold to Facebook for $400 million. Tech investing is like Hollywood accounting because something can sell for 10 times or 50 times what investors put in, and investors can barely break even. The 5x multiplier means I make it a little back. I know someone that put a few grand into the friends and family investment in a company that raised an angel single-digit millions but sold for $500 million. I thought it would net them at least $1 million out of such an incredible return, but they only got 5x what they put in. AlphaWorks changed their name in late 2015, and the Twitter account associated was updated. So anyway, they got acquired, and it's a long tweet stream that we'll put in the show notes. What are you guys' thoughts on this? And explain to a layperson who might be on AngelList or the Syndicate what happened here and why the early investors got ghosted, never got any information, and then in all likelihood got hosed. But we'll see what the eventual outcome is.
Preferred stock.
So explain it in layman's terms.
So the, I guess, market price, at least in the early stage investment, is a 1x, which means that the liquidation preference on any of the first money out will go to the investors up to exactly the amount, hence the 1x, that they put in, supposing that they decide not to convert to common, which basically means if the deal is for less than the amount that they previously raised at, then the investors are going to get their money back first. Their last round was a $72 million raise that valued them at that $600 million. I don't know the total amount that they raised, maybe in the 100 range, which means that if this early investor didn't see anything, then there was a multiple on the liquidation preference somewhere along the line, likely in that last round, which meant that those investors would have gotten their money back over earlier investors, and especially
in this
over the
case,
common.
it would have had to been a 5x or something, right? Because if they bought it for $400
so
million,
I'm curious.
Depends how
about
much
that.
total capital they raised.
if they raised $100 million and that last round was 72, if they had a 3x liquidation on the last round, which would be incredibly high.
Right. But
That
also,
would be
it might not be
200.
that, 400's the reported price. Maybe there's an earnout. Maybe there's a carve out for the founders. Maybe the,
Right. So if there was an earnout, let's
this
say
money
it was
gets
$200
divided
million
up.
in cash and
Yeah.
$200 million earnout, and they had a 3x liquidation preference, the last investors would get all of it. They would get all the money. And then maybe somebody, if there was an earnout, would get that. This is why it's important for you to, number one, trust the person who's the syndicate manager. And I think in this case, there is no manager. They sold the company twice. And I think Assure Fund Management, which we're investors in, which was the back end for AngelList for a long time and a lot of other platforms like Seed Invest, they do the SPVs. That company, I think, became the stewards of these investments. That doesn't mean they were actively managing them like a manager like us. But that's the active manager's job, is to make sure that the capital gets preserved as best it can. We did two things to avoid this type of tweet storm, which this could have happened to me for an early investment or two in my syndicate. We had a company, Video Pixie, that refused to send updates. It was like a YC company, so they were super entitled, and they wouldn't send. I shouldn't really talk out of school about companies, but anyway, this one was such a disaster. I had these fights with the founders over and over again because they wouldn't tell the investors how much revenue they were making. They wouldn't tell me unless I would meet with them in person. And they're like, well, we talked to YC's lawyers, and they said we don't have to give you information. I'm like, you might need more money, dipshits, in the future.
But
Yeah.
You want me in your
technically
corner?
you don't have to. I guess I'm learning the documents as well. It was one of my first 5 investments as a syndicate. I was like, yeah, but I gave you money, $250,000. Why wouldn't you want to tell me how my investment's doing? And these guys were such idiots. They wouldn't give basic information. And then the company went out of business. They were like, oh, this is why commentators like me. So they're like, I breathe down these guys' throats. I was like, you're damn right I breathe fire down their throats. They wouldn't tell the investors how their investment was doing. That's why we put into our documents a side letter that says, you will give us monthly updates as part of this investing. Now, would we sue a founder and do we get 12 updates from them? No. We probably get on average 6, 7, 8 updates a year. It's a lot more than 0. And if they hit 3 months without sending us one and I call them and it's we haven't got one in 3 months, I can point to the side letter and say, you did agree to monthly. It's been 3 months. Can you try to hit monthly for the rest of the year, right? I can be reasonable about it. And the reason we want the monthly update from you is so that we can invest more. Then I said, if we own over 5%, we have the option of a board seat. Or 10% is what we used to do. Now I say 5%. And people want me on their board, but that's an aggressive term that I started putting in. I said, listen, if you want...
Do you personally sit on the board?
What I do is I do a team approach. So I'll have Ashley, who is one of our managing directors. We have 20 boards that we're on collectively, and one of the 2 or 3 of us will go to that. So Presh and Jackie are starting to come to with me now. So the 4 people on the investment team, some combination of them will be at the board meeting. Some people only want me there. I'll have a discussion with the founder about that might be unrealistic, but okay. And then we don't take the option every time. But at least you have that. Then you have the protection of knowing that a deal's coming. And you have a seat at the table to protect against something like this. And you can communicate. Because if these investors had a chance to be in that round and said no, that would have been great. Then they could say, listen, you had the opportunity to be in this round, you passed. It was pay for play. If Matt had put $2,500 in that round, he would have got triple his money. And his first investment wouldn't have gotten money, but his last one would have. So those are the protections just for people who are wondering. And we'll take a deeper dive into this and something else. But what do you think?
Wait, do you know the other previous interesting other previous cap table thing? After they raised the $17 million at an $80 million valuation, or I'm sorry, just before that, Facebook actually tried to acquire them. This was back in late 2014. So if this is the second go around with Facebook.
So if Facebook had bought them for $80 million, that first group of investors who invested at $10 million would have
Probably
had a 7, 8x or something, which they would have felt great about. Right, a nice investment, 7x in 5 years. So anyway, buyer beware. These are high risk investments. The later stage investors do beat up on the earlier stage investors, and that's why you have to have a strong manager to be able to mitigate against that. That's what I've spent the last basically 5 years doing, is building in triggers for me to protect the investors. You can't do it every time. A big investor can come over the top. Like, you need only watch Billions or any other sharp-elbowed show about,
Great show.
If you watch Billions, like, yes, people are doing nasty swinging elbow shit, but if you got somebody who can swing elbows like me too on your team, I've had to swing elbows at people. Like, I've had this happen. Have you guys had this happen where people try to cram you down or block you after you've made an initial investment and screw your LPs?
I was involved in a total recap scenario once, and that was, like, if there were any, quote unquote passive folks in that situation, like, they not only were they just getting run over, like, nobody was even thinking about them. Like, it was only people.
Did they
who were
even
active
inform
at the
them
table.
that they were about to be washed, or did they tell them retroactively they were washed?
Yeah, they got informed,
Yeah.
but it was like it was after the recap was already structured and agreed upon.
Yeah, I've seen a handful of pay to plays, and everybody gets the notice that you're gonna have to pay to play, and it sucks to see that, but like, at least they told you.
Yeah, pay to play is. I always tell my founders, like, when you do that pay to play stuff, just understand that now you've ruined your relationship with all those previous investors. You're never going to be able to raise money from them again because they're going to feel screwed unless you've really communicated to them and you can say, listen, I talked to 40 investors. They all said no. The 41st said yes. If we bring the company from a $50 million market cap down to a $20 million valuation, which means that we're going to recap. And in order for you to have shares, you've got to put more money in. I'm sorry that it came to this. We tried everything we could. Here's a list of everybody we, reached out to. But, very few people do it that way. But I've told people, if you choose to do that stuff with us, I had one founder who just, as part of a down round, re-upped themselves to like some, massive amount of equity. And they said, well, the person doing the investment forced me to take more shares. And I was like, well,
oh, that's a good one.
Yeah, and I kind of had that reaction, kind of laughed. I was like, well, what about all of us who put money in?
Yeah, did you push back on that at all, or no?
I pushed back on it tremendously.
No, like your question to them.
Well, no, I said, like, okay, well, we put all this money in. If you want us to continue, do we get more shares or whatever? And they were like, well, I had no choice, and so then I disengaged from the company. I said, we'll monitor our investment here. We'll consider every round. I said, but after you gave yourself a massive reward for failing to grow the company, that makes it hard for me to tell my LPs and my syndicate to invest more money, right? And I had this like very candid discussion with them. They still didn't understand it, like, but I had no choice.
Was it a pivot to a new business, or was it a continuation?
No, it was a down round
because
they got a couple bad beats. That happens.
Yeah.
But and he said, well, how would you have done it? I would have said, to the existing investor, I would have said, I can't take this, but I'm willing to discuss it in a year if I hit these targets, getting a new grant, and if the board approves it. They're like, no, the new investor would never do that. I was like, okay, I'll talk to the new investor. And he wouldn't let me talk to the new investor. He's like, I think you'll kill the deal. And I was like, okay, I won't talk to the new investor. There's only so much I can do, and the wins are so big. I don't want to be up in a founder's grill about this stuff, but founders do need to know, and that's why I talk about it. And I'm creating a composite here. Nobody would be able to figure out the company. But I talk about these composites on the podcast so the founders know what's going to happen if you screw previous investors.
I think there are two scenarios here. One is like what you're talking about is definitely bad. Like, you're continuing the business. The other is like you're like, the business didn't work. You're shutting it down and you're pivoting to a new business. That is a little bit of a different scenario.
Sure.
And actually, the best thing to do in those cases I've found is, because I've been through brain damage, is just kill the company.
Yes, less bad feelings.
Less bad feelings.
Fred Wilson has like an amazing blog post on this that Jason, I'll send you so you can put in the show notes of like why it's better to just end the company in that situation.
Yeah. I mean, the thing I've seen is giving warrants to people. So you keep the valuation where it was, but you give people 10 more. If the company became worth 1/10 the price, the new investors buy a share at the last price and they get 9 warrants they can buy anytime in the future at this. So if it does work, you essentially keep the valuation where it is. There's all kinds of creative things to do. But always think about your investors. Big picture.
One quick point here I want to make on GIPHY before we move on. And I know we have killed lightning round here, but
we killed lightning round. Yeah.
Switching from deal to intrinsic,
we like to go long on acquired.
Yeah.
One reason why GIPHY didn't have any negotiating leverage here is they didn't have a material business. They weren't obviously a sustainable business. But why didn't they? They're this. They have a crap ton of daily active users. I don't know what it is, high hundred millions. And So what's the deal? Well, they don't actually have a strong relationship with those daily active users. Most people, I think more than 50% of the GIPHY traffic actually comes from Facebook through APIs, which means if you think about Slack's API and all these other APIs, most people are not going to GIPHY.com. So if they were going to have an ad-based business model, they don't really have an opportunity to sort of say, hey, what about this GIF? They really are at the mercy of who's calling the API. And unless they're just going to like load sponsored images into there, they don't have a big canvas to work with there. And so I guess the moral of what I'm saying here is, and this really ties it all the way back to the Clubhouse thing, is think about if you're one of these consumer companies who kind of has a tiger by the tail, but you need to think about business model at some point, you kind of need to think about like, okay, what type of relationship do I have with the user? How strong is it actually? How much time do they spend with me? How much do they remember the name of my brand? How much are they coming directly to me, not through another tool? And then make sure that your canvas is broad enough that whatever your business model is, ad or asking for money or whatever it is, like make sure you can actually do that. Because in GIPHY's case, there really wasn't a way to do it.
Yeah, there was no business model there. I mean, it's really challenged. What do you think the business model will be for Clubhouse? We teased that a little bit early on. We will wrap with Clubhouse. What do you think the eventual of the product? We all like the 1.0 of the product. What do you think that product ultimately is to consumers at scale in terms of business model?
Well, one thing I would try if I were them is promoted clubhouses. So right now the UI is literally just like, here's a clubhouse, here, a room, and each room sort of is just a set of people. And that's not going to scale, right? That's going to become a really tall list really fast. And so discovering your rooms is going to become either rooms where your friends are in it or rooms where someone notable is in it. And you want to discover one of those two paths.
So you open up the app, it shows you the 2 rooms your friends are hosting, and the third room is a talk show or a QVC talk show type thing, or a promotion
or
for
even
Goop.
Exactly what's going on right now where you've got some celebrities hanging out. But assuming that lots of celebrities are going to want to do that, you could open up a sort of event style model where you pay for placement and say, hey, like if you want to reach this huge audience that's in Clubhouse,
we'll put you
and you
want
to do a Clubhouse with them, like cool, we'll build you a stage here and we're going to charge you for it.
So if you're Star Wars, New Mandalorian's coming out, you have, the director or Jon Favreau comes on and does a fireside chat, and Disney pays for that and gets a link to Disney Plus to sign up for it. And it was a promotional thing.
Yeah, I would try it. I think there's lots of other advertising.
David, what do you think?
Which
is your favorite? What's your favorite model for it?
Oh, well, I mean, I'm biased, but the LP shows worked pretty well for us. And I could imagine running that on Clubhouse. You've got some influencer has following, and it's a subscription service or a paid.
That's what I think. I think that's what they're going to do. I'm with you.
Behind the scenes.
I think it'll become like, you remember fan clubs? People would pay to be in the Britney Spears fan club or, whatever. The Grateful Dead were kind of like this giant fan club. But people used to have like a paid fan club, and you would get a newsletter, I guess, you would get like every month a newsletter. But then it kind of became a phone call. Like you would call into a phone number and you would get some artist. So imagine you're Tim Ferriss and you have Tim Ferriss's Clubhouse, and Tim says, I'm going to just go on there, 5 times a month, and you can be a member for $10 a month or $5 a month. And it's sort of like a Patreon model. And, have you guys, what do you think the previous best iteration of Clubhouse was? And then have you seen anybody kind of pivoting towards Clubhouse, as we often see in this kind of space? House Party, I guess, was sort of like Clubhouse for video.
Yeah, I mean, the closest thing is actually the thing that the founders also started inside of their little incubator that was their shell entity for this, called Talk Show. It was live podcasts. And I think like Simil Shah had been on a bunch of them. But you can kind of see how they jumped from this sort of like tune in to someone talking now to tune in and maybe we can all talk to them now.
Right.
So I think, the
serendipity is kind of the strength of it right now. I'm interested to see if this thing wears off. Like I got a little bit of Clubhouse fatigue the last couple of days because when I went on, I noticed.
Is that because you didn't get into the deal? Or?
No, I had noticed it even before the deal was announced that when there's somebody notable in there running it, or a couple of friends, it's really interesting. So when I was on there, I was interviewing Adam from Quora, and I interviewed Alexis from Reddit and Initialized. They just happened to be on there, and I just did a mini interview. And then Ben Horowitz came on, and I just took over the microphone because there were 20 people who had the microphone time. And I said, oh, Ben Horowitz is here. Let's do a mini interview. Ben, da-da-da. And I started asking questions. I just took the thing over. And in both of those cases, the rooms just grew and grew and grew because you had some professional moderation. Other times I come in and people are just like screaming and talking, and then you get these lulls and they're like, what next? And like, I don't know, let's all change our avatars. And it's like really boring, right? Like that's what people were doing. They were changing their avatars and then saying 3, 2, 1, refresh. And I was like, that's kind of interesting. But I do think you're going to have, just like there's YouTube stars or podcasting stars, there could be Clubhouse moderator stars, like mods who are just like this.
And I will tell you, it's a different
moderators.
skill set.
Totally
like I thought
different.
my podcaster skill set would translate, but like the thing that makes Acquired great is David and I go do a crap ton of research, crawl down an internet rabbit hole, and then turn a narrative and turn it into a narrative and pull out key themes. And like in Clubhouse, the skill is you have about half a second to come up with like the wittiest, most clever, novel thing you can to the last person that someone said. And it's a totally different skill set. And
Dinner
so I
party.
think there's going to be new creators in there that thrive in that new format.
It's like a salon it's like you have to be good at the salon format or the news roundtable format, which is you have to be able to state, well, no, it's true. And think about what we did today in a news roundtable. You know, I've got 2 really smart guests with a lot of experience. I put stuff up. I put myself out there and I try to be vulnerable and like here's my opinion. And I'm showing you that I'm going to be totally candid and honest, hope to get you candid and honest. And then when you say something interesting, I try to loop the other person in and you'll see me say, oh, that's great, David. Ben, what do you think of that? Or Ben, where do you fall on the cynicism to
you're
most
a great
cynical of it?
moderator.
But, that took time to do. And,
You're 1,000
McLaughlin
episodes
group.
in, right?
Yeah. And probably a third of them are roundtables or 25%. It's called passing the ball. And so when you're on CNBC, if you really want to be good at that, what you have to do is at the end of what you're saying, like they bring me on as an expert, Shamath on as an expert. But what's really good is if there's happens to be another person on or passing it back and saying, well, Carl, what do you think? I mean, are you going to upgrade to an iPhone 11 or are you fine with your iPhone 10? I mean, just look at yourself, look at your family. What is your pattern? Do you line up? Would you even think about going the next day to get the iPhone or are you going to wait? And he's like, that's a fair point. Yeah, we actually, we wait now. We do it every other time. That's when you can pass the ball like that and get an assist. It's kind of like LeBron who, or like Michael Jordan passing to Steve Kerr or LeBron passing to somebody and like they hit the 3-pointer. It makes him just an even more dynamic player.
Yeah, so the people that have compared themselves to Michael Jordan in the last 2 days include Masa Son and Jason Calacanis.
And Chris Sacca. No, I compared myself to LeBron, to be clear. But no, I do think passing the ball is like really the skill.
Yeah, that's a great point.
It is.
You guys do it pretty nicely.
How good is The Last Dance, by the way?
I can't watch it because of the PTSD from the Knicks. I was at all those games. But now is it done? And how many parts is it?
It's 10. I'm on episode 6 right now.
Is it completed?
But I think 9 and 10 just came out.
Yeah,
my plan was to wait, and then I am 10 parts just finished it. I am so exhausted from this goddamn coronavirus shelter in place.
Jason, you're gonna love this.
I've decided. I'm making an announcement today that I'm going to take a month off.
Whoa,
nice.
And when I say take a month off, I'm taking a fucking month off because my brain is fried. Now I don't know if I'll make it 10 days, but my intention is to rent a beach or a lake house somewhere. And I am going to reset my brain for 30 days this summer or over Christmas or sometime in the next 6 months. Because, I mean, how are you guys doing through this?
I love it. I just tried to do this. And actually, I ended up being successful. But it's hard. I had like 2 false starts.
Of taking breaks.
And you did 2 weeks, right?
Yeah, I did 2 weeks. Yep. And I wasn't totally off. But like the first time I tried to do it, first and second times I tried to do it, I'd be like, okay, yep, I'm taking a break. But then nothing changes. Like, I'm still doing.
No, my idea is to find something I can do with the family that's off the grid and that takes attention every day. So I was thinking about maybe a whitewater rafting trip or maybe driving across the country. Check my email at the end of the day or whatever. But I'm thinking about like doing something like that where I do like a 2-week or something, maybe a month. And then, I'll probably phone in for the accelerator, probably the only exception. And I'll just book 8 episodes of the podcast ahead of time, do 8 great interviews, and then, and bag them, which I could do in a week. But it's just how are your brains? How are your brains right now through coronavirus? Is this impacting you guys? Like psychologically, how?
This is weird.
Just weird. Yeah.
It's weird, and there's like such a quest for certainty right now because it's uncertain. But the end of the day is like nobody actually knows what the fuck is going to happen.
You have to surrender to it, right? Like it's a really scary thing to think this thing could mutate, and the next wave could kill children instead of old people.
Well, and it's not even this
or
thing,
any other permutation, right?
The craziest thing is we're actually very lucky that either the viral coefficient wasn't higher or that the fatality rate wasn't higher. Like, what if this thing had been as fatal as SARS, and like the next thing could? It's wild to wrap the mind around that. Actually, we're luckier that it wasn't worse.
Yeah, to see 30 whatever percent the unemployment's going to wind up at 20%, 35 million people, whatever it is. Like to see all of this happen concurrently. And then still not know on a disease basis exactly what's going on because, and again, it's not a political show, but when you look at execution and leadership, it really does matter. Like your ability to have great leadership, to have people in office who can execute, and from top to bottom, I mean,
this is not a political show, listeners.
It's not a political show. I mean, we did bring up Elizabeth Warren and AOC, but it kind of proves my point. Like they shouldn't be involved in entrepreneurship. And then when you look at their job they're doing, I mean, the job that's been done here has been executed so poorly. We can't even get people to wear a goddamn mask. Like this is the most basic request that from top down, top to bottom, every single political person should walk up to the goddamn podium wearing a mask and say, I'm now going to lower my mask to speak to you for 30 seconds because everybody is 10 feet away from me. And we know that when you were within 6 feet, if I were to cough on this microphone, it would need to be sterilized, da-da-da-da-da. And we need to have everybody comply and just wear a mask. And we need you to wash your hands. And we have masks and Clorox wipes that will be delivered by the U.S. Postal Service to every mailbox every month. And the government's paying for it. So you do not have to worry about your Clorox wipes or your hand sanitizer or your masks. And if you have them, please give them to your neighbor or keep them for the next pandemic. These three basic things, washing your hands, using the antibacterial, wearing the mask, is your national duty. I'm Jason Calacanis, President of the United States. Like, why can't the fucking president say something that simple? Why can't every leader say something that simple? And why can we still fly on packed planes but not work at a factory? Why can you go to Barton Trader Joe's but not build a Tesla? None of this makes sense. And nobody can seem to explain it in plain English to everybody. Like, what's your explanation, Ben? Like, how would you explain to people they can go on a packed United flight with 300 people in a canister for 5 fucking hours?
I see that assist there. That was nice.
That was nice.
I mean,
well, look, I think...
How do you explain this?
Part of the reason I think that we're in sort of this, like... it's confusing. You can do one thing but not the other right now is, the purpose of shelter in place when it started was not everybody stay in your house till there's a vaccine. It was everybody stay in your house so we don't overwhelm the hospital system.
Yep.
Now that, with the exception of a few cities, we didn't overwhelm the hospital system, or at least maybe we did, but we're sort of like back.
No, even New York, they had extra
beds.
Every single place has had extra beds. Nobody hit capacity.
Some places there was, but like there were lots of places in New York that were actively doing triage on which life to save, and that sucks.
Yeah.
But
is that correct? At the peak, they were triaging
yes.
like that. I thought they didn't run out of beds, but okay.
Or at the very least, they had enough beds, but like there were constraints.
Maybe not enough.
There were
doctors and nurses.
Yeah, and so now we're in this interesting place where like, we are starting to open things because the purpose is not to stay in our houses until there's a vaccine. However, some people totally can stay in their houses till there's a vaccine. Like I'm one of those people, and my life is adversely affected in lots of ways, but like, could I tough it out? Totally. And so you're seeing some people who are like, well, I may as well just do that, or I may as well only break a couple rules, but everyone else is saying, look, the floodgates are open. We did it. We crushed the curve. Now we're out. And so you have this like wild...
Do you feel because your job is not impacted in a dramatic way, you can still work?
Yep.
You haven't been furloughed, obviously. Do you feel that you have more empathy or less empathy for the person who has no revenue and needs to actually go to a place to get work done, that they can't work behind a keyboard?
Well, I think there aren't natural, there's not natural empathy created there, but like you got to find ways to think of it. Like my life is so different than that person's life. Like,
do you think they should stay home, or do you think they should go be a gardener, or go be a waiter, or go be a bartender, or whatever it is, or go work in a factory?
I think everybody should do the thing that they need to do to make ends meet and take care of their family and do these things. And simultaneously, I think that if you don't have to go to work, you shouldn't go to work yet.
So now the way you just said that is so plain English and easy. Why can't a politician say it just the way you did? It was beautifully stated. And you do not hear that narrative from any politician. Politicians should be saying, if you can
it's
stay
hard.
home.
I said two things that conflict. So what's the policy out of that?
The policy is, it's very simple. I'm about to tell you something that sometimes in life, you will have conflicting thoughts and conflicting instructions. Just like this is a lose-lose situation. The pandemic is deadly for certain groups of people. We know that. That's confirmed. And it spreads like wildfire if you don't take precaution. And we know that people die if they're unemployed, and opioid abuse and suicide. And we understand you have to feed your family. You don't want to starve. These are two lose-lose situations. If you can stay home and if you can see less people, that's helpful for everybody because it keeps the coefficient down. And if you have to go to work, we understand, please take these precautions. And it's very important you take these precautions and you don't interface with people who are high risk. These are conflicting, but these are complex, nuanced issues. And I don't know why the goddamn politicians and the media that are so polarized can't just tell it straight to the American people.
All right, Jason, bring us home.
David, what do you got? You have any thoughts on that?
That whole thing. Do you have any thoughts generally, David? On
no, just I realized I didn't pass the ball to him, so he got frozen out on that one. So just want to make sure.
No, well, I appreciate it. I'm not. The only thought I have is the old Charlie Mungerism by way of Ben Franklin, which is if you would persuade, appeal to interest and not to reason. Like, you actually want people to do stuff, you got to figure out some way to like create an alignment of incentives that it's in their interest to do stuff. Otherwise,
Here's a very simple one. Don't kill your grandmother by not wearing a goddamn mask, dipshits.
Yeah, that's good.
I mean, do you love your grandma? Then wear a goddamn mask and wash your hands. It's that simple. All right. This has been a great episode. Thanks for tuning into This Week in Startups. Hey, thanks, Ben and David. If you guys don't get the Acquired FM podcast, it's absolutely fantastic. And you can subscribe too. They have their LP show, which is really fantastic. And I did a 2-parter with them recently. You go buy that, give it a shot. It's well worth it. I think they only charge like $100 a year, right?
Yeah, but the main show's free. Come check it out.
Show's free.
Comprehensive history of every company you care about, lessons learned along the way in any podcast player.
All right. Then thanks to my team working really hard remote. Thanks to the investment team, Jackie, Presh, and Ashley doing a great job. Thanks to the sales and operations teams, Maureen, Charles, and Nick. And thanks to Laura and Heidi also on operations. And to my sales and business development team, Luke and Matt, keeping the lights on. And it's not easy to sell right now, but you guys are doing a bang-up job. Did I miss anybody on that, Nick? I think I got everybody, right? I think I got everybody. If I left you out, it was not intentional. But really, one of the great things, great joys of my life has been building this team at launch and also at Inside. And wow, what a great job the launch team has done stepping up during this time of crises when our founders really need us to step up. So I appreciate all the hard work. People are working 20-30% harder than I think they do on average. So, and we already are a hardworking company. If you want to chop it up and talk about it some more, Acquired FM has a Slack room, which I got inspired to turn ours back on. Ours is at thisweekinstartups.com/Slack. Is the Acquired one, do you have to be a paid member to get in the Slack, or is it for everybody?
Nope. Almost everything we do is free. It's just the...
How do you get in the Slack? Is it acquired.fm/Slack?
Yep, that's it.
Yep.
Okay,
Button
great.
on our website.
All right, yeah. So go join both of those Slacks. I'm in the Acquired Slack once in a while. We'll see you next time on This Week in Startups. Bye-bye.